First one I got two. The first one is the one that got like the 2 people. The last one I got one wrong. I don't remember which one I got wrong.
The first one I got.
Yes.
Thank you.
You have to? Sorry. No. What we just did. And the previous one. I'm trying to get higher. Like, 75. And this, I'm going to take the exam and try to boost that.
Yeah.
Might as well.
Yeah. I had 87 in the last test, and I took the test. I got 75.
Okay, very good. Thank you.
But it's much better when we make the test the same day after the class.
That's what?
It's much better when we take the test at the same day after class.
Yeah.
Because the first test, the class was last week. So I was kind of...
Okay, make sure you got the spreadsheet pulled up that I sent you yesterday. Everybody got it pulled up? And does everybody have the handout that I just passed
The
out?
whole thing? So no test for you?
Which is the spreadsheet.
Fucking man.
Okay. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right, well, let's go and get started. So what I have sent you is a combination of both an after-tax as well as a before-tax model. Originally, we're going to be scheduled today to just do the before-tax, but since we already kind of introduced it a couple of weeks ago, I figured what the heck, we'll go ahead and jump forward and do both before-tax and after-tax today. And then that'll free us up to do another spreadsheet for one of the other classes. So, this one, once again, fully populated. And so what we're going to do is kind of walk through it, explain everything that you sort of need to know about this one, and some of the unique features that deal with some of the after-tax issues. So those of you, there's a couple of you in here that have taken the investments course, so this can be kind of a refresher for you. Those of you that have not taken the investments course, then this will be brand new stuff, so not a problem. All right, so the way this model is obviously set up, much like the others, you've got a whole series of inputs up here toward the top that obviously we use down below to kind of populate the pro forma. And then we've got a number of sort of return calculations and then also some cash flows and a handful of other things. So we're just going to walk ourselves through this. All right. So to sort of start us off, much like the financial feasibility analysis spreadsheet and others, we start off with some of the basic property information in terms of the rentable square feet in the property, the actual rent per square foot per year. So in this case, those should be fairly normal to you in terms of what they are. Same sort of thing with the vacancy rate, 7% here, other income per year of $15,000, and then the annual operating expenses based on effective gross income, in this case only 5%, and then a required debt service coverage ratio by the lender of 1.3. Okay, I don't think any of that is new to you. Is that correct? Or it shouldn't be, because we've been doing this stuff for quite some time. So hopefully that is all just normal. Okay, so the actual first calculation that gets done, that you don't have to do, that obviously is being done by the spreadsheet, is to calculate the NOI. Now, without actually pulling up the formula, how would you be getting NOI? What variables are you using to get that? Well, are you?
Operating expenses.
Okay. So you're taking basically what? To get the calculated NOI, you're getting that indirectly by what?
Operating expenses minus the, or plus the.
PTI minus VCL or income.
Plus other income, gives us
Effective gross income.
effective gross income, subtract out our operating expenses, gives us net operating income, and then subtract out annual debt service, gives us basically forecast cash flow. Okay. All right. So in this case, if you look specifically at the formula that was used to get the net operating income, all it's doing is it's pulling from down below, cell B25 to be exact, okay? So it's simply pulling from down below, get this thing so I can use it. So in terms of the actual calculations that are being popped in here, it's just simply pulling up that net operating income number from down below, all right? Now, the maximum annual debt service based on the debt service coverage ratio, that is simply going to be using your net operating income, which is right there, divided by the debt service coverage ratio right above it, which will give us the maximum annual debt service based on the debt service coverage ratio. We've done that before, okay? Once again, so far, nothing new, okay? Then, the maximum monthly debt service based on the annual debt service. So this is just simply taking the annual debt service and dividing it by 12, okay, to get our monthly mortgage payment, okay, or monthly debt service. Okay, then we have basically our loan information, very straightforward, the interest rate on the loan of 4.5%, 25-year term, okay. Then based on that, we're using the present value formula to calculate what's our loan amount, okay? So we're sort of backing into that using that monthly mortgage payment, that interest rate, and that term. That makes sense? Once again, we've done all that before. All right? Then we take that amount and we use our loan to value ratio to back into the value of the property. So in essence, we are taking the loan amount divided by the maximum loan to value ratio to back into the maximum value of the property. Okay, does that make sense? So it's a reverse calculation, but we've done it before. Okay. Now, based on that number, the $31,465,000, if we take that number, subtract out the calculated loan amount, then we should get our required equity that we need to put into the property in terms of our equity investment or down payment. Okay? Make sense? Okay, any questions on that? Okay? Now, let's go and take a look at a couple of these things up here at the top. Specifically, just the annual rent growth rate. I put it at 3%. So we're going to have our growth on our income at 3% a year, and then our operating expenses are going to grow at 4% a year. Okay, for right now, ignore all of this stuff about depreciation. Okay, we're going to come back to that when we start talking about the after-tax stuff. And that's also sort of the new stuff. Okay, so let's just take a look at basically years 1 through 5 and what's happening down here in terms of our before-tax cash flows. Okay, do we all understand how we come up with each of those numbers? Okay, in other words, where each one of these, we've done this before, but I just want to make sure. So obviously with the potential gross income, we're just pulling from above in terms of our square footage times our rental rate. That becomes our potential gross income. Okay, and then simply as we go across, what is happening is we are multiplying that income number by the growth rate in the income. Okay, so everybody see that? Okay, once again, nothing new there. Okay, and that continues all the way across. And I'm going to talk about year 6 here in just a second, but right now just focus on years 1 through 5.
Are you multiplying by annual rent growth or annual OPEX growth rate?
The income growth rate. Okay. Vacancies and collection losses, we're keeping it at a fixed percentage all the way across. In this case, I believe, yeah, 7%. Now, one thing to point out here, everybody who builds a model like this, they have their own sort of preferences as to how they deal with some of the different assumptions and how they change and how they don't change and that sort of thing. This particular model, I simply made the decision or the assumption to fix my vacancy and collection losses as a fixed percentage of 7% all the way across the property. That's not an absolute. Matter of fact, it probably is not even going to be accurate, you know, from the standpoint that obviously if it's the first year you own the property and you're going through lease up, that first year you're probably going to have a much higher vacancy and collection loss than you will in the subsequent years. But that's a decision that you've got to sort of make up front as to, or you can actually go back and make it change from one year to the next, okay? And that may actually be one of the things we've got to do here in a little bit, okay? Other income, same thing. I just fixed it at a dollar amount all the way across, okay? So nothing was changing there. Once again, this is an assumption that I made. Doesn't necessarily mean that it has to be that way, okay? And then the operating expenses, I fixed that as a percentage of the effective gross income. Once again, you can vary that from year to year, okay? Which I think we actually did, which was to say, whoops. Yeah, we have an annual operating expense growth rate of 4%, so that number, while the first year is based off of the effective gross income, the subsequent years are simply being grown at a 4% growth rate. Okay? Does that make sense? All right. Moving on down. Okay, and so that, obviously doing all those calculations, that gets us to our net operating income. Now, the one thing I want to sort of point out is you notice there's a year 6. Does anybody remember? We talked about this. Why do we calculate year 6 all the way down to net operating income, but we stop there?
For the reversion.
For the reversion, okay? Because to calculate a reversion, we always base the reversion value off of the subsequent year's income stream, okay? To apply the cap rate. So we only calculate it down to the net operating income because that's all that really matters to us, okay? All right, moving on. Okay, our annual debt service, that number's fixed all the way across, and then we get our before tax cash flow. Okay, all of that should have been just completely a review. Nothing new there. Was there? In your mind? I don't think there was. Okay, now, here's where it begins to be fun. Okay? When we start dealing with tax-related things. And obviously, a lot of this is probably about to change in terms of some of the different tax rates, as well as some of the different deductions and a handful of other things. We don't quite know. The last time that we had a major overhaul was probably in 1986. You know, so a good 30 years ago was, I mean, we had a minor one back in the early 90s, mid-90s, but nothing like the one in '86 that really changed everything for real estate. And that's one of the reasons we had the real estate crash that we did in the late '80s, was because of tax law changes. So let's talk about what is actually happening here. Now, the way I always typically sort of start off any discussion as it relates to income taxes is there's a very different distinction between the tax world and the real world, okay? The tax world is one that is governed by rules and regulations that are very precise and dictatorial as to how things are impacted and affected and how values may be impacted and affected. The real world, there are usually a whole bunch of other extraneous variables that may impact things that don't necessarily align at all with the tax world, okay? So in other words, what I'm sort of saying is the tax world, to a certain extent, is its own sort of animal in terms of how it behaves. And just because the tax world sort of says the value of your property is this, doesn't mean it is, okay? Or that, the depreciation is this and versus the real world. So try to make a complete disconnect between sort of the tax world and the real world. Okay, that having been said, part of what we have to do is to take a look at some of the different variables that get impacted within the tax world. One of the things that we deal with in the tax world is depreciation, okay? And in the tax world, it has been determined that commercial real estate properties have a 39-year useful life. Why 39? Why not 45? Why not 25? Because Congress said the useful life of a commercial property is 39 years, okay? Now, in their minds, that is simply saying that over 39 years, your property goes down in value equally from one year to the next by 1/39th, okay? Does that make sense? Okay? Not saying it matches up at all with reality, but that is how they set it up. Now, residential properties have a tax life or depreciation life of how many years? 27.5 years, okay? Not 27, but 27.5. So, why do you think you would give a different depreciable life to residential properties versus commercial properties? In your mind, if you had to give a rational explanation, why would you give a longer useful life to commercial properties relative to residential?
Could it be that at night you're at home, at night maybe you're in your commercial property, so you're not using it as much. And also, the utilities that you have in the residential is much more than you would have using your commercial property, right?
Maybe.
Yeah, I mean, that's possibly an explanation. I'm not sure that that's
The reason.
the reason. Anybody else?
Yeah, maybe American lifestyle, raising families, people in the house. That's kind of a calculated average. Raising kids, sending them to college, how long people will stay in their house before they retire, maybe move on. I don't know,
Okay,
just
possibly.
a guess.
All right, anybody else? Yep.
Materials used?
Yeah, that's the one that I tend to gravitate toward. That commercial properties as a whole, if you think about them, much higher quality of construction. That most, now Florida's a little bit different in the sense that we have to hurricane-proof everything. So residential properties are probably pretty close to almost the same standard as industrial, in the fact that they're built out of concrete masonry units and that sort of thing. But most of the country, that's not the case. And residential homes, it's just stick frame construction that may not really be expected to last that long a period of time. But as a general rule, I think the logic was, yeah, materials are probably going to be a little bit more expensive, and you're going to have a higher quality of construction overall, and you're going to have a higher durability that you need to have in place for commercial buildings than you do with residential. And so they just kind of arbitrarily, sort of determined, okay, 27.5 years for residential, 39 years for commercial. Interesting note about that is that prior to basically the 86 tax laws, it was like a 31.5-year depreciation term for commercial, but they upped it. And part of the reason why they upped it was because they felt that that was too short of a depreciation term and people were getting too much of a tax benefit from the depreciation, and they wanted to potentially have that as a less impactful sort of issue on owning commercial real estate. And what I mean by that is, think about it like this. Well, tax policy is probably one of the most boring things that most of us would tend to want to think about and want to imagine. But every one of those decisions that are made about tax policy not only impacts you potentially as an individual, but as an investor in terms of the ownership that you have of these properties, and can, in some cases, make or break your investment decision, okay? As boring as they may be, all of a sudden a change in tax policy makes your property unprofitable or makes it more profitable. You know, so instead of necessarily just sort of sitting back and not really, you know, thinking about this, it's one of those things that, you know, can have huge implications on the income that you generate, okay? Yep.
Do the banks also calculate that when they want to lend you money?
In what way?
The 39 years and the 27? Because
No.
you have a lot of properties that are like 30 years old, so do they deduct the price?
Yeah, I mean, whenever they have an appraisal done, the appraisal is going to estimate the effective age of the property, which is not necessarily going to be anywhere close to what the tax depreciation value is.
Okay, thank you.
And on a personal level, when you buy it, doesn't the depreciable life start over again?
Yes.
Yeah. Oh,
Okay.
So there's a whole other side to this that's fascinating, that let's say I buy a property today, it's a brand new property, okay? You know, just been built. So I start the clock on my depreciation. If it's residential, I start the clock over 27.5 years. If it's commercial, over 39 years. But let's say 5 years later, I sell whatever property I own to you. The depreciation clock starts over.
So I got 39 years old.
Yes. Okay? But once again, this is what I'm saying. Tax world versus real world. Okay? You know, and so as a result, that, you know,
Depreciation is equal for me and you.
well, yes and no. I mean, it's in terms of where we start. But the problem is, you have a 5-year-old building that has 5 years probably worth of wear and tear associated with it.
Correct.
Okay? And now you're sort of starting the clock all over. Doesn't necessarily match up, is what I'm saying. Okay? But that's what I'm trying to get at whenever I'm saying the two worlds aren't necessarily,
They don't think the same.
yeah, they're not in alignment. Okay. So let's just sort of take a look at this whole business of depreciation here for a second. All right? So one of the input cells that you have to make a determination on is whether the property is commercial or whether it's residential. If it's commercial, it's going to be 39 years. If it's residential, 27.5. And you have to, I believe, just hard code the number in there and make it like a nifty little if-then thing. We maybe try to do that a little bit later. But what is important is what follows next, and that is what percentage of the overall property's value is actually depreciable. And what we mean by this is only improvements are depreciable, meaning land is not depreciable for tax purposes. So the idea behind that is land is forever, you know, and so it doesn't make sense to depreciate or write off the value of the land from one year to the next, because it should be basically constant or fixed and, you know, should not be depreciated. Now you can make some arguments that, well, what if it, you know, it's like got toxic waste on it or, you know, something like that. You know, you maybe can make an argument, yeah, it's been depreciated, but for the most part, you know, it doesn't depreciate. So what you've got to do is basically say, what is the overall value of this property? And you're going to apply basically 80% to that, and then simply say, that is going to be my depreciable value for the property. All right, so in this case, to see what value we're using, my suspicion is we're using, yeah, over here, the overall value of the property. So let's take a look at this. 31,465,853.98. All right, so this is the overall value of the property. And we are saying that of this value, we're going to assume that 80% is attributable to the improvements, okay? In other words, the buildings or structures on the property. So 31,465, 853.98 times 0.8. Okay, so it's going to mean 25,172,683.18 is the actual value of the improvements. And the difference between those two would be the value of the what? The land. Okay, does that make sense, everybody? Yeah. All right. Now, if that is 80% of the value, this is the value of the improvements, this is the depreciable value, and our property happens to be commercial, we're going to take this number and divide it by 39 years. Okay? So divided by 39, you get 645, 453, 41. So that should match up with what we've got up here under annual depreciation. Okay? Does that make sense? Okay? So this is the annual amount of depreciation for a commercial property where 80% of the value is attributed to the improvements. There is our depreciable value each year that we can write off. Now, what does that actually mean? That means, technically, for income tax purposes, we take that overall value of the 31 million, and each year, we're basically, for 39 years, we're really subtracting out $645,000 off of that value until it basically gets to zero. Does that make sense? So the improvements get to zero, not the land. Okay, so at the end of 39 years, the value of the property will be just the land value. Does that make sense? Okay? Now, of course, the IRS doesn't always make things simple. Okay? They have to complicate things up a little bit. And so, one of the things that they put into the regulations is they want to avoid people gaming the system, okay? And so they require you to identify when the property was placed into service, meaning what month was it placed into service. Because here's the thing. If you place it into service, let's say January 1st, that's 12 months of depreciation, which is what you think you should be getting, yes? But what if you waited until December 31st to actually buy the property and place it into service? If the IRS didn't basically have this, what we call MidMonth Convention, then you would get a full 12 months worth of depreciation. You'd be gaming the system, if you will. Well, they want to keep you from doing that, so they have what is referred to as a mid-month convention, meaning that whatever month you place it into service, you only get to take the depreciation from the 15th of that month. So if you place it into service at the 1st of the month, or you place it into service the 30th, the 31st of the month, or you place it into service the 5th, the 20th, whatever, the IRS automatically makes the assumption that it's placed into service on the 15th, or middle of the month. That's called the mid-month convention, okay? So you've got two things going on here that are important. One is the month that it's placed into service, which month in the year, and the other is the mid-month convention, so that you only get half a month. Now, what that actually translates into, as a practical matter, is if you place it into service in, let's kind of run down through these, January, February, March, April, May, June, July, August, September, October, November, December. Okay? For January, because of the mid-month convention, you get 11 and a half months of depreciation. For February, 10 and a half, 9 and a half, 8 and a half, 7 and a half, 6 and a half, 5 and a half, 4 and a half, 3 and a half, 2 and a half, 1 and a half, and half a month. Okay? Now you're saying it's an awful lot of detail. Well, it is, but it's also extremely important because this will cost you or benefit you thousands of dollars, okay? In the fact that you've got to know when the property was placed into service. Now, placed into service is not the same inherently as whenever you purchased the property, okay? Because you purchase raw land, you build a building on that raw land, but that building is not available for occupancy until maybe, you know, a year or two later. So it's technically not going to be placed into service until it's open for occupancy. Okay? That's when you get to begin collecting depreciation. Now, if we use the example of you know, what Kim had suggested earlier, that you know, I own the property for, let's say, 5 years, and I sell it to Payman after 5 years. Payman, you know, buys an operating property from me. Okay, under those circumstances, if we keep the doors open, we never close them, then you're able, the day of the closing, to say the property is placed into service that day. All right? So, why am I going into all this detail? Because it matters for the calculation for the depreciation. Okay? So, in this particular spreadsheet, we've got, it asks for what is the month it's placed into service. And here, I said it was month 10. Which would have meant October, okay? And so based upon that, our depreciation gets adjusted, okay? So let's see if we can do the calculation. So what that means is, if it's placed into service, basically here in October, that means I'm getting 2.5 months out of 12 of depreciation. Does that make sense? Okay? 2.5 months out of 12. Okay? There are 12 months in a year, and if I place it into service in October, I'm getting 2.5 months of depreciation for income tax purposes. So what we would do is we take this number, this is our annual number, divide it by 12 to get a monthly number. And we get 53,787.78 is our monthly depreciation. Okay? Well, if we place it into service in October, as we said, we're getting 2.5 months worth of depreciation. So that means that we're getting $134,469.46 worth of depreciation for that first year. Does that make sense?
For the first year? Oh, yeah.
For the first year only. So now, if we take a look at your spreadsheet on the handout or on your computer, and just scroll down specifically to the annual depreciation number or line, what do you see? First year is $134,000, and then it jumps up for every year thereafter to the $645,453. So you get the full year's worth of depreciation on every subsequent year, but for that first year, only based upon what month it's placed into service. Now, one little thing that I did, take a look at the calculation here for the mid-month. And this is a nifty little thing to kind of help to do what we just did. Basically what you're doing is you're taking the annual depreciation number, cell E11, and you're multiplying it by 12.5 months, since, once again, everything's kind of based on halves, minus what month it was placed into service, divided by 12. So think about this for a second. 12.5 minus October, which is 10, would be 2.5.
Right.
And so then all that divided by 12, and that gives us our depreciation for the mid-month. So it's just some simple math, okay? All right, now, moving on. Okay, everybody comfortable with doing that calculation? All right, moving forward. So once again, if I were just to ask you, what does depreciation represent for tax purposes? Give me an explanation.
Lessening of the taxable value.
Yes, that would be a good, simple explanation. It's just the lowering of the taxable basis or the taxable value of the property over time, okay, to theoretically reflect depreciation, wear and tear of the property, okay, deterioration, okay. Now, okay, this next one, I'm going to kind of explain what we're doing here with these little calculations, because you're probably like, why are we doing all these weird little calculations here? But I'm going to come to that in a second. One of the things that we need to do is to calculate interest expense. Now, how is interest expense different from your mortgage payment or your debt service? It's deductible, but more specifically, what's the actual difference between them?
It's minus the principal.
Minus the principal. In other words, the interest portion, separate, if you at the mortgage payment overall, you subtract out the interest, you have left over the principal payment. Okay? Well, here's the thing. For income tax purposes, only the interest portion is tax deductible, not the full payment. Okay? So what you're beginning to see here with this little subroutine calculation is that for income tax purposes, what we're doing is we're subtracting out what we can deduct, okay, from our overall value or our overall income on the property. And so we're starting off with net operating income, and we're subtracting out the annual depreciation, we're subtracting out the interest expense, and once we've subtracted out those two, and there are others that we can include in there to make this more complicated, like for example, amortization of points. We could also be subtracting out other financing costs and things like that, but in this particular case, we're trying to keep it simple. But after we subtract those out, that then gives us what is now going to be referred to as our taxable income, okay? So it's not our net operating income that's being taxed in the full. It's only after we've adjusted that for depreciation and interest expense that's going to change our taxable income. Now, think about this just for a second. Don't make this more complicated than what it really is. What if they disallowed interest deductions? What if they disallowed depreciation deductions? All other things being equal, we would pay more tax. Does everybody see that? Okay, so that's why tax law matters, is because if all of a sudden they say, okay, the depreciation term has changed from 39 years to maybe 45 years or to 10 years or whatever, that's going to dramatically influence this number, okay? I mean, just look, right now, look, since we've got this sort of fixed, let's just go up and let's just say we change it to make it a residential property, just to see how much of a difference it would make. Okay, so going from 39 years to 27.5. No other changes. All right? And you automatically see the annual depreciation amount went from $645,000 to $915,000, And then for that first year, it went up from 134 to 190. Well, let's come down here and just look at our income. You know, that's having a very significant, substantial impact on what our taxable income is as well for each of those years. Okay, which is obviously going to translate into how much tax payable would we have. Okay, if we look at the handout, just to make the comparison with what's up here on the board, we would have been paying $240,000 in taxes payable if it was a commercial property, but because it's residential, we're only going to have to pay $225,000. So a difference of 15 grand for that first year. For the subsequent year, though, it's a little bit more dramatic. We've got a difference here of $121,000 in taxes payable if it's commercial, but only $45,000 if it's residential. And the reason for that much of a difference is because we're only talking about 2.5 months here, whereas this is the full 12 months. So you're talking, about what, almost 80 grand, roughly, of difference in just the taxes on the property, nothing else. Does that make sense? Okay. So yes, it matters. Okay, let's put that back to where it was. Put that back to 39 years. Okay, as we continue to kind of work down through this. Okay, now then, we talked about what the interest expense is. How do we calculate it? How do we get it there? Take a look at the formula that's used here. This is one I don't believe we have used. Okay? It's the cumulative interest payment. Did we use that or not?
No.
I'm kind of beginning to think maybe we did for something, but
Mine just says 28% of the form.
no. The interest expense. Okay? So this is another function. I don't think we use it in here, but does anybody remember whether we used it in this? I mean, I know we used it in the investments class, but I can't remember whether we used it in this one or not.
I think on the first spreadsheet we used it.
Okay.
Yeah.
Okay. Well, anyway, whether we have or we haven't, I'll go through and explain it again. Okay. The function is CUMIPMT, cumulative interest payment. Okay. And then all we're accessing here, so you can sort of see the interest rate, the number of periods, present value, and then the start period, and then the end period and time. Okay, so this is kind of like the amortization function on the calculator. The whole thing where we do shift, amortize, equal, equal, equal. That's basically what this thing is doing just for the interest piece, okay? And so if you take a look, and you kind of break it out, item by item, the B12 divided by 12 is simply the interest rate divided by 12. The B13 times 12 is simply the number of periods in months, but the part that, and then we get the present value, which is simply B14, but the part that is interesting to us is the start period and the end period, okay? So what this is saying, for this particular point in time, this is the first 12 months, okay? So that is period number 1 through period number 12, thus the 1, 12, okay? The 0 is the type, which once again, that is the whole beginning versus end of the month thing here, once again, end of the month, okay? But now take a look at the cell to the right of this one, okay? The only difference that you're going to see is, now it's for year 2, periods number 13 to 24, okay? Then the subsequent year would be 25, 36, then 37, 48, 49, 60, okay? Make sense? Okay. All right. So once again, a nifty little function. Okay. Taxable income is kind of coming back to this. So all you're doing here is you're taking your net operating income, subtracting out your depreciation, subtracting out your interest expense to get taxable income. Now, what we're actually doing with these 1, 2, 3, 4, 5, 6 lines, this is what I always sort of refer to as sort of a tax calculation subroutine, okay? Because we're sort of taking information from one part of the spreadsheet and kind of just doing a set of calculations that we have to do to be able to come up with the bottom line, which is the taxes payable amount, okay? And so once we've got the taxable income from these first 4, Then we simply multiply that by whatever the appropriate marginal tax rate is. Well, is that not another thing that's under discussion right now with regard to the changing of the tax laws, okay? And so supposedly simplifying it down from whatever it is, 7 or 8 different tax brackets now down to maybe 4 or whatever it is. And obviously, as those change, that's going to impact obviously your tax liability, okay? Now, so the taxes payable, you're simply multiplying the taxable income times that tax rate, you get the taxes payable. And we're going to make the assumption, which is a fairly valid assumption, that the tax rate is going to be roughly consistent across the page. Okay, moving forward.
Professor, we're paying interest in base of 12 months if we got the property on October?
Okay, good question. All right, so in this particular case, we are making the assumption that while the property was placed into service in month 10, we're sort of making the assumption that we may have bought it in January. But we could obviously adjust it to where that it was only placed into service, or only the mortgage was calculated and everything else calculated as if it was 2.5 months. Okay, that's a good observation. All right, moving forward. All right, so the before tax cash flow, what we do here is we take our before tax cash flow, we subtract out our taxes payable, which we have calculated from right above that, and then solve for after-tax cash flow. Okay, so that simply gives us our after-tax cash flow for the year. Now, subsequent to that, one of the things that we're going to do here is we're going to do a few return calculations, all right? And one that you can call return on asset, or just simply the net operating income divided by value, also cap rate would be another way to sort of look at that. So here, you're simply going to take whatever the net operating income is for that year and divide it by the value that we came up with. Okay, so we've got the net operating income of the $2,046,300, divide that by the overall value of the property of the $31 million, and we should match up with the 6.5% as a return on asset. Now, one of the things that we sort of see as we go across, and this is an assumption that I made, is that the value we're keeping constant as we're sort of moving across the page, but the net operating income, as it changes or goes up in this case, then the overall return on asset changes. Now, once again, this is a super simple spreadsheet. A lot of the complexities haven't really been built into it in terms of making an adjustment for the value changing from one year to the next. We could have made that one of the assumptions and changed the value, and then ultimately that would have impacted what the return on asset would be. Now, the before tax return on equity calculation, that is simply the before tax cash flow So before tax return on equity is our before tax cash flow divided by our equity investment, all right? So in this particular case, for that first year, our before tax cash flow was $472,223.08, all right? And our equity investment, we go back up, was $7,866,463.50. Okay, so let's do that, just double check, see if it's correct. And what we get, 0.060029, basically around 6%. Okay, yep.
Is that kind of the same as a cash on cash return?
Yep.
Okay.
It's another name for it.
Okay.
But same thing. So you got cash on cash before tax return on equity. Okay. And then the after tax return on equity. Same formula, except you're using the after-tax cash flow. Okay, so your after-tax return on equity is after-tax cash flow divided by the equity. So in this case, the after-tax cash flow, 231, 268.16. Once again, if we do the math on that, we should match up with a 2.94%. Double check. And we do. 0.02939, or basically 2.939%. Okay? So it makes sense. Now, here's an interesting question for you. So would you expect, as a general rule, probably in most all cases, with a few exceptions, your after-tax return on equity to always be lower than your before-tax return on equity? Yes or no? Why? Because you're taking taxes out. Okay? About the only way that it could ever not be lower is if you were getting tax credits. Okay? Like, for example, historic tax credits, low-income housing tax credits, or other related tax credits that would potentially allow your after-tax cash flow to somehow be higher than your before-tax cash flow. But very seldom is that going to be the case. Okay?
So, it's higher tax evasion or something like that?
No, it's not so much tax evasion. It's just simply that there's got to be something that's, like, for example, what we would probably see is, here with our quote-unquote taxes payable, we would see another line item that we would insert in there that would be tax credits. Okay? Because there's a difference between a tax credit and a tax deduction. People always get them confused. They think they're the same thing, but they're very different. If I were to say, okay, I'm going to give you a $1,000 tax deduction versus a $1,000 tax credit, which would you prefer?
Credit.
Absolutely, hands down, without any question whatsoever, you're going to prefer a tax credit. The reason for that is a tax credit is a dollar-for-dollar reduction in your income taxes payable. So in other words, if I gave you a tax credit of $1,000, then I'm just simply taking this tax payable number and I'm subtracting out $1,000. Do I follow that? Whereas if I give you a deduction of $1,000, it's going to be like this interest expense. It's going to be multiplied, after you get the taxable income, it's going to be multiplied by the tax rate, and so you're only going to get basically the benefit affiliated with the tax paid, okay? So you're only going to get basically about 28 cents on the dollar in terms of the benefit. Does that make sense?
Is there any instance where the credit wouldn't be the better choice?
Unless you just don't qualify for the credit.
So why would there even be an option? Why would they just...
Well, I'm trying to just to illustrate the concept.
Oh, sorry.
But as a general rule, I mean, like I said, the big ones for real estate, for tax credits, historic tax credits, health preservation tax credits, if you basically take an older building or historic building, there are different income tax credits that basically, for every dollar you spend on the rehab, then you will, in essence, get back a fixed percentage tax credit.
Okay.
Dollar for dollar reduction in income taxes payable. Whereas with tax, and the other big ones are going to be low-income housing tax credits. Same thing. If you provide and build low-income housing, you will get a dollar for dollar reduction in your income tax payable for those properties being built, up to a certain percentage. Okay?
Don't we have to adjust the property value over the years to get a higher ROE in our way? Because every year the property value goes up based on the NOI.
So one of the things, that's what I was saying earlier, that this model doesn't do that. This model is meant to be a very simple model and not necessarily make a lot of the other little assumptions that we potentially could make. And so you're absolutely right, that as you gain equity in the property, you could be effectively arguing that you've got more equity in the property because of equity buildup, and therefore your return calculation should be based upon your current level of equity in the property and not based upon the initial amount that you put into the property. So that is an assumption that you could make, absolutely. Okay? All right, so once again, we're keeping those somewhat static. You can kind of see what happens, obviously, as the property sort of matures. For the most part, those return measures go up. Okay, moving forward. Okay, so now what we begin to do is basically say, all right, let's look at the actual cash flows being thrown off by this property and put those into basically kind of a return measure, like internal rate of return, net present value. So what I have done is broken up into three major sort of return measures, which are going to be looking at assuming that it was an all equity deal, all cash, which it's not, but assume that it were, what would be the cash flow streams associated with that? What would the cash flow streams be if we are obviously putting equity into it, we do have debt, what is going to be our cash flow streams on a before tax basis, and then what are going to be our cash flow streams as if it's on an after tax basis. Now, why do we want to separate these things out? Well, once again, most of us, whenever we think about returns, and pretty much almost any investor that you talk to, they're almost always going to refer to their before tax returns. They're not going to be really referring so much as I want to get an after tax return of X%, because most investments are just, whenever you're talking about, you don't know what an individual's tax liability would be, because each person is going to be different depending on how much overall income they have, or whether or not they're an individual versus a corporation versus a partnership versus a syndication versus a joint venture versus something else, okay? Because those different ownership structures are going to influence whether or not, you know, they have to pay taxes or they don't, and what rate, you know, and that sort of thing. So most of the time whenever you're quoting anyone a return measure, it's on a before tax basis, okay? That's simply said. But that having been said, if we know the details of this particular investor and what they're being taxed at in terms of what rate, it makes sense for us to go ahead and do the after-tax calculation so that we can see what is their real take-home after applying the tax rates, okay? All right, so let's make sure that you know where these numbers are coming from. The $31,465,853.98 is simply what? The overall value of the property, okay? And then the cash inflows. See what those numbers are. Where are we pulling that from? Net operating income. So years 1 through 5 of net operating income is all these numbers represent. Now, the cash flow at end of year 5 plus reversion, that is simply going to be the final year cash flow of NOI plus whatever the reversion value is. Because if it's an all equity deal, there is no debt, so therefore you don't subtract that out. So all you're going to be doing is basically taking this number, the reversion value, which you're getting by taking and applying the cap rate of 6.5% to the year 6 NOI. Okay, so if we, just to kind of prove the point, year 6 NOI, go up here. NOI for year 6 is equal to $2,363,653.73, all right? And if we divide that by the 6.5% cap rate, then we're going to get the value $36,363,903.54, which should match up basically with this, or pretty darn close, okay? Off by a couple of pennies because we're rounding, okay? All right, make sense? So, this is just simply going to be taking those cash flows with our reversion value, and then once we've got that, then just doing the basic return calculations of internal rate of return and net present value. So starting with internal rate of return, you should be able to match up with that 9.44 by plugging in all of this into your calculator, same way that you do any of the calculations. Your initial cash outflow is going to be the $31,465,853 as a negative cash outflow, and then all of the subsequent years as positive cash flows. Solve for internal rate of return, and you should get the 9.44. Okay, make sense? Okay, and you would, in essence, you would apply the same approach for the others. We're going to talk about the differences there here in a second, but let's finish up with the all cash deal here for a second. Now, take a look at this. Investor hurdle rate for the net present value. We've talked about this a little bit, but I want to make sure this is super clear in your mind. What is a hurdle rate? Real simple. It's a target rate, or it's the rate of return that I, as an investor, am setting for myself or for my organization that I must meet and I must get over in order for me to do whatever investment. So in other words, if I've set the hurdle rate at 20%, okay, for an all equity deal, have I met that hurdle rate? No. So in other words, I could not do this deal if it was an all equity deal, because the rate of return that I'm actually getting is 9.44, but if I did it as an all equity deal, 9.44 is not sufficient for my equity. My equity demands maybe a 20% rate of return, all right? So in this case, I'm saying, well, my hurdle rate is not met, therefore we get a negative net present value. It doesn't make sense for me to do this investment, okay? Now, we're going to get into the other ones here in just a second, but I want to start up at the top with the before tax cash flows. Okay, does everybody understand the first column? Yes? Okay. So the second column with the before tax cash flow, what we're doing, look at the dollar amount of the outflow. The dollar amount of the outflow in this case represents what? The equity, okay? That's the amount we're putting into the deal. Well, is the equity the same for whether it's a before tax return or an after tax return? Yes. You're expending the same amount of money in both instances up front whenever you buy the property, okay, in terms of the equity contribution. But what is different are the cash flows subsequent to that. So here, the cash flows for the before tax return, that's simply going to be using what? Your before tax cash flow for each of those 5 years. And in the 5th year, we have to add in the reversion value. Well, here, this is where it begins to be a bit trickier, okay? In the investments class, we'll get into even a little bit more detail on this. But if you go down toward the very bottom here, under these assumptions, the whole extra set of calculations that we've got to do as it relates to the sale of the property. So we've got to go through, figure out what the original adjusted basis of the property is, that $31,465,000. What is that? That was the improvements value of the property. Okay? Then we got to subtract out all the depreciation that we've had over the 5 years of ownership to give us our adjusted basis at the sale. Then, from that, we're going to do another little subroutine, take the sale price of what we sold it for, subtract out that adjusted basis that we just calculated. Then that's our gain of $7.6 million. Then, from that, we have to subtract back out the cost recovery depreciation to figure out the overall gain from appreciation in the property. Now this is really where it starts to get interesting and wacky, because you get taxed on 2 different things here. You get taxed on the value of the property going up, which is the tax on appreciation, But you also get taxed on the depreciation that you have taken, or the recaptured depreciation. In other words, here's the logic. The IRS has said, oh, you bought this property, it should have gone down in value, not up in value. Therefore, we've given you all these tax benefits for all this depreciation for the past 5 years, but what's actually happened is the property has gone up in value, so we want you to pay us back the tax benefits that we have given you for the depreciation over those 5 years. That's what's called cost recovery recapture. In other words, the IRS is basically taking what they gave you and taking it back, okay, and taxing you on it. Okay, does that make sense?
So do you ever win?
No.
And they're hitting you for your appreciation as well.
So this is why currently we have 2 different tax rates as it relates to the sale of the asset. We have a tax on the cost recovery, which is basically the recaptured depreciation, which has a 25% tax rate, and then we have a tax rate on the capital gain, which is at 20%. But then we have a different tax rate on ordinary income, which is 28%. Okay, so you've literally got 3 different tax rates as it relates to different types of income that the property is generating over its life. Okay, so yeah, it begins to make your head spin, you know, and then as, once again, tax law gets changed, all that then blows up, and you've got to basically figure out what the new tax law is doing and how that's going to impact you, and then how do you maneuver your own ownership structure to basically reflect that to your best advantage. But the point with this, and like I said, we're not going to get into the nitty-gritty detail in this class as much as we will in the investments class, but the point is you're going to take what you sold it for, subtract out the balance of the loan. That's going to be what are going to be referred to as your sales proceeds before tax. So this is the number, this 15,629, that's the number that we use as the reversion value for the before tax cash flows, okay? So you can take a look and see that those numbers match up. Yep.
Is the capital loss allowance included in the tax on capital gain?
Yes, I'm sorry, one more time?
The capital cost allowance, is that something included in tax on capital gain or tax on capital?
Are you talking about for?
Yeah, that's something I read on the Wall Street Journal, that properties are paying too much in capital allowance.
Are we talking about for capital expenditures?
Yeah.
Okay, so one of the things, typically whenever you make an expenditure on a real estate property, it's going to be classified as either a capital expenditure or repair and maintenance, okay? You know what the difference is, Payment? The difference between a capital gain or as specifically a capital expenditure versus a repair and maintenance.
One is recurrent and the other one is like once in capital gain for
Yep.
3 years.
So basically, as an owner of real estate, in many cases, you have to determine from one year to the next whether you're going to classify an expenditure as either a capital expenditure or as a repair and maintenance. If you classify it as repair and maintenance, you get to deduct it immediately within that tax year. So in other words, if I go out and I buy a bunch of new carpet to install in a building, all right, and say that carpet cost me $100,000, I'm going to write a check today for $100,000, put the carpet in, but now the question is whether that carpet is going to be considered to be a repair and maintenance expense versus a capital expenditure. If it's considered to be a repair and maintenance expense, I get to deduct the full $100,000 of that expenditure in that tax year. But if it gets classified as a capital expenditure, then that allocation of that expense has to be spread out over the useful life of that carpet. So if we say that carpet has a useful life of 5 years in a commercial setting, then what we're saying is I can only, for tax purposes, then deduct 20% of that cost each year, basically, for 5 years. And so you have people at large real estate holding companies whose almost sole job it is to do nothing but classify whether something is going to be a repair and maintenance expense or a capital expenditure, because it matters so much in terms of whether they're going to be, how they're going to be taxed. Because would you rather get the tax benefit off of your ordinary income versus the tax benefit off of the recaptured depreciation? Well, there's a difference in tax rates. You got a 28% tax rate versus basically a 25% tax rate. Okay, while that may not be that significantly different on millions of dollars, it is. Okay, all right, so we go through, this is once again going to be our reversion value for the before tax cash flows, and then after we subtract out the two different taxes that we have on the sale, one being the recaptured depreciation, the other being the gain on the sale, the capital gain, in other words, the amount above and beyond what we paid for it, then this gives us our sales proceeds after tax, which is what the value that we're going to use for the reversion for the after-tax cash flows. So if you look at that, those two numbers there obviously reflect the numbers from down below of simply what the reversion amounts are. Okay? Does that make sense? Okay, so those get added in, obviously, to the final year cash flow. So the 16,352 is going to be equal to the 15,629.73.80 plus what? The final year before tax cash flow of year 5. Okay, just like what we've done in other real estate finance calculations. Okay, and then the final one on the after-tax cash flows, same thing. This is simply reflecting, obviously, the 13,971 plus the final year of the after-tax cash flow. All right, now, let's jump down here again, let's take a look at our internal rates of return for each of these. So, the return that we said that probably matters the most to us is really this one, the 20.43%, the before tax internal rate of return, because that is the return measure that most of us are going to relate to in terms of what is our return on a before tax basis. So that is, in essence, our return on equity on a before tax basis. Now, in this case, let's say we set a hurdle rate of 15%, all right? With kind of the logic there being that the bank is basically financing the lion's share of this. We're only having to contribute a small amount of equity, therefore we don't have as much exposure. Therefore, we're willing to accept a lower hurdle rate, okay? It's kind of the logic that we're sort of using. But based upon that, under these circumstances, would we do this project?
Yeah.
Yes. Because if the project is returning 20.43 and our before tax, as our before tax internal rate of return, and our hurdle rate is only 15, then that means we're getting, in essence, a profit above and beyond our hurdle rate of over 1.8 million. Okay? Does that make sense? Okay? Now, on an after-tax basis, we're certainly setting the hurdle rate a little bit lower, only to kind of reflect that we know there's going to be a difference between the before tax internal rate of return and the after tax, simply because of the income tax. So we're not going to set as high of a hurdle rate. So in this case, I just set it at 10%. And once again, our after tax internal rate of return is 16.3. Our hurdle rate for the after tax is only 10. So yes, it makes sense. On an after tax basis, we're actually going to be walking away with 2.3 million in essence as profit. So without question, this investment makes sense. If it is an investment that we make with debt. If we made it as an all equity deal, it doesn't make any sense at all. Yep.
I guess I'm just struggling to understand the logic as to how your value is increased after you pay taxes in this scenario.
In this scenario, the reason would be because the hurdle rate is lower.
Okay.
And it's not enough, okay, put it this way. If I were to raise the hurdle rate to where it's equal to the before tax hurdle rate, see what happens?
Yeah.
Okay, so by setting it somewhat lower, oops, you know, it's going to have a significant impact.
And you just put those numbers.
Well, it's dependent, in other words, most of us go into any sort of investment, or at least I do, and say to myself, all right, I'm not gonna do any investment unless I can get, let's say, 20%. All right? And if I can't get 20%, I'm not gonna do it. That's my hurdle rate. Okay? So you may say, I'm not gonna do any investment unless I get a 25% rate of return. That's your personal hurdle rate. It's unique to you or unique to your investment firm. Okay? In most cases, most institutional investors will have a very precisely picked hurdle rate that they want to achieve. You know, and it's just like any investment that doesn't meet that is immediately thrown out. Any investment that meets that hurdle rate, then they're going to take a serious look at and more than likely invest if there's no other issues to basically make them not invest in it. But it's the only reason it's there is it's a threshold that the expectation is you need to meet that threshold at a minimum in order to move forward.
To be interested in the project.
To be interested in the project. Okay? Other questions? Okay. Now, so let's do this. So what if I were to like say, okay, on an after-tax basis, I want to net $500,000. Okay? On an after-tax basis with my hurdle rate. Okay? What would I have to do?
Second rate of value.
No. Okay, let me make sure I'm being very clear. I want this number here to be $500,000. How do I get it to be $500,000?
Make the hurdle rate higher?
Your hurdle rate.
Make the hurdle rate higher. Okay? So if I go over to the hurdle rate and I type in, let's say 15%, it gets me to 425. All right? Well, what if I go to 14%? Oh, too low. What if I go to 14.5? Oops, 14.5. What if I go to 14.3? Oops, too low. Other way. 14.6. 14.7. Getting very close. Okay, within $7,000 at 14.8. So the point being is, if I am basically saying I want to get cash, if you will, above and beyond my hurdle rate of whatever it is, what would my hurdle rate need to be? Okay? Does that make sense?
Can you repeat that?
Okay. That if I simply want to get profit, if you will, of $500,000 or as close to it as I can get, okay, what would my hurdle rate need to be set at? In other words, that would be kind of a benchmark. In other words, because my goal might not be to get a certain percentage. My goal might be to get a pile of money, you know, and I want a $500,000 pile of money, okay? But what does that mean? That my hurdle rate would need to be set at in order to achieve that. Okay, does that make sense?
Do you recommend
Because your net present value is what amount you have left over above and beyond your hurdle rate. Yep.
So that's not necessarily the profit after 5 years, that's the profit plus what you.
Well, it's all a way of how you twist it and contort it, okay? Because what we're saying here, or what I was saying was, I want on an after-tax basis $500,000 sitting on a table, you know, for me, in essence, on, you know, on kind of an after-tax basis, but prior to actually making this investment. What would be my hurdle rate? What would it need to be in order to allow me to achieve that? Okay? Now that may have no relationship inherently to what the actual rate of return is. It's just a different way of sort of coming at the problem.
But if you
I mean, I would still, see, now, in this particular case, the other interesting piece of this is that this hurdle rate is less than the actual overall after-tax rate of return, okay? And so what we're basically saying is I'm willing to actually accept lower than what it actually is throwing off, as long as I get my $493,000 above and beyond that.
If you put the rate of return in the hurdle rate, it's gonna be the money that the profit that
Right.
it's trying to.
Yeah, so I mean, it's like, for example, if I were to type in, without even doing it, if I were to type in 16.3 right there, what is my net present value gonna be? Zero. Let's just see. Or $349, but only because we're rounding, okay? Because then they equal, and therefore you end up with basically a zero net present value. Okay? Because where your internal rate of return is equal to basically your hurdle rate, your net present value is equal to zero. Okay? All right? Other questions? Yep.
You hear NPV, you hear internal rate of return throughout commercial real estate investment. Some people prefer one or the other. It's just out there. I think you understand what I'm saying. Why prefer one over the other? Is one
It's a way of looking. It's a way of looking at things. Do you look at things in terms of raw dollars, or do you look at things in terms of a rate of return on a dollar? You know, to me, the raw dollars, that reflects a pile of money. In other words, like for example, if I invest $100 and I get a 10% rate of return on $100, that's $10. Right. But it's also a 10% rate of return. But if I invested $1 million and I have a 10% rate of return, that basically is $100,000. Okay, so would I prefer $100,000, you know, versus $10? Yeah. But they're both the same rate of return, okay? And that's the thing, it's just a question of, usually you're going to use both because you're wanting to not only reflect, you know, what is the rate of return, but also what is the magnitude in terms of the dollars that are being generated. Question?
No, I was just thinking, in my mind, if I'm comparing investments, it's always better to have the rates, I think. Wouldn't that make more sense if you're comparing rates rather than dollar amounts?
Well, once again, it depends on what your objective is. That's why I specifically targeted the pile of money of the $500,000. You know, it may be that my objective is just to accumulate a certain set dollar amount, and that's what I'm going to be happy with, versus what the actual percentage rate of return is. Because sometimes people think about returns in different ways. Some people think about returns as just simply a payback period. That how many years is it going to take for me to recoup what I have invested? You know, that's a very simple sort of measure. That if I spend $100,000 on an investment and it generates $20,000 a year, that means it's going to have a 5-year payback period. Okay? Assuming then no residual value, well then I got paid back exactly what I put in. But if it generates $25,000 a year for 5 years, then I'm actually going to get back an extra 25 grand as a result.
And that would be the NPV.
Yes.
Okay.
Okay. All right. Let's see. Anything else? Okay, so other questions?